Hello there, and welcome to Finance with Hughes. Today we'll be going over a few financial ratios that are commonly used in financial statement analysis, and we'll just jump right into it. And I'll just share my screen, and we will get into it. So some of the most common financial ratios are the liquidity and activity ratios. There's also the profitability and solvency ratios, and we'll get to that in a separate video. But basically these two types of financial ratios. First, the liquidity ratios. When you think of liquidity, it's essentially how quickly an asset can be turned into cash. So generally you want higher liquidity for liquidity ratios. And for the activity ratios, it typically measures how often you turn over something. So like the accounts receivable turnover is, how many times you go through your accounts receivables in a year. And we'll kind of get into that and how to calculate those as well. But getting right into it. So the current ratio is the first liquidity ratio that we'll go through. It is probably the most common liquidity ratio. And what it consists of is a company's current assets divided by a company's current liabilities. And so whenever an asset or liabilities is current, that means it will turn into cash within 12 months, typically. So that includes things like cash and cash equivalents, marketable securities, accounts receivable, inventories, and things typically put to prepaid expenses or prepaid, pretty much just prepaid expenses. And then all the other types of assets besides those are typically long-term assets, and those are typically, PP&E or property, plant, and equipment, fixed assets, intangible assets, goodwill, and then any other sort of miscellaneous asset that will be on the balance sheet for more than a year. So to do the current ratio, and here I have Johnson & Johnson as an example for years 2021, 2020, and 2019. For a lot of ratios, you'll just need the balance sheet, but for some, you'll need the income statement as well. And that's why I have Johnson & Johnson's income statement down here, because we'll need that for just a few of the ratios in the activity section. But to calculate the current ratio, what you will do is you'll take a company's current assets and then divide it by the company's current liabilities. And that will give you the current ratio for a given year. And then I just drag that across to calculate the current ratio for 2021 and 2020 and 2019. With the current ratio, you want it greater than 1 because that represents that you have enough current assets to cover your current liabilities. So you don't really want less than 1 because then it's saying you have more current liabilities than you do current assets. So you want it over 1. So in the event of, something happening in the company, you have enough assets, current assets to cover your short-term liabilities, essentially. And that's just a quick way to measure that. So with Johnson & Johnson, you can see they're pretty well over 1. So that's good. And generally you don't want it too high above 1 either, because then you're kind of using too much current assets, and you could make the argument that it would be better spent, that money better spent on long-term assets like property, plant, and equipment and other things rather than sitting in the current assets for that long. Okay, so that's the current the current ratio. And then the quick ratio, which is also called the asset test ratio, is very similar to the current ratio, although it takes out the inventory. So it's just the current ratio, but in the current assets, there's no inventory. And that's just a different way to look at kind of a similar ratio. But because inventory gets turned over so often, it's just a different way to look at a company's ability to pay off its short-term obligations. And then the current cash debt coverage ratio. So you will need to grab the net cash for operating activities, or net cash produced by operating activities, which I don't have on here, but it is right there. I grabbed this from the statement of cash flows for Johnson & Johnson. And so you'll need that figure to compute the current cash debt coverage ratio. And so what this tells you is how well a company can pay off its debt, or how well a company can use its the cash produced by its day-to-day activities, otherwise known as operating activities, to pay off its current liabilities. So with that, we'll take the net cash from operating activities for 2021, and this one they want to use the average current liabilities number, which to get that you would take the current liabilities of 2021 plus the current liabilities of 2020, divide that by 2 to get the average, and then do that for all the years. I can't do it for 2019 because I would need 2018's numbers, which I don't have on here, to produce the average current liabilities, but that is how you would do that ratio. And also, whenever they talk about average current liabilities, you're essentially taking the ending amount for the year and the beginning amount for the year. So the amount that's on the balance sheet for a given year will be the amount at the end of the year, because that number represents, whether it's December 31st of that year or whatever their fiscal year ends, it would be that the end of that year. And so same with the previous year, but that end number will become the beginning number for the next year. So like the beginning number or the ending number for 2020 would be the beginning number for 2021. And so that's why we use 2020 and 2021's numbers. Yeah. And so that's the current cash debt coverage ratio. So those are 3 pretty common liquidity ratios. There are a few more, but those are, some of the more common ones. And so onto the activity ratios. The first one we're going to look at is the accounts receivable turnover, which basically tells us how many times we go through our accounts receivable. And this kind of tells us if we're collecting on those accounts receivables enough, or the liquidity of them. So this, we would take the net sales, which in this case would just be sales to customers, divided by the average accounts receivable. Here they have it as trade receivables, but it's the same thing. So you can also do the average function in Excel, where you just take the average of the current year and the previous year. And so we can see that for 2021, the accounts receivable turnover is 6.49. For 2020, it's 5.88, and we can't do 2019 because we don't have 2018's numbers. And so this tells us that for a given year, the company turns over its accounts receivable 6.49 times. And with that, you can then use that to calculate, how many days it takes them to go through their accounts receivable. And for that, we would just do 360 divided by the turnover ratio. And then this would tell us how many days it typically takes the company to go through their accounts receivable. Which, with a lot of these ratios, it's also important to keep in mind that you don't want to look at these in a bubble. In order to determine if that's good or bad, you either want to compare it to the same company in previous years or other companies within the same industry. Because you could look at, the current ratio and say 1.34, is 1.34. You can't really tell if that's good or bad without looking at either the company's previous current ratios or what competitors have for current ratios. So that's important to keep in mind whenever you're looking at these ratios. And then similar to the accounts receivable turnover, we have the inventory turnover, where it's the cost of goods sold for the year, which we can get from the income statement, divided by the average inventory, which again, we can just use the average function in Excel to do the average inventory. Do that for 2021, 2020. So for 2021, they go through their inventory 3.02 times or 3.03. And then same with accounts receivable, we can figure out how many days in inventory that they have by doing 360 divided by the inventory turnover. And so here we can see that it typically takes Johnson & Johnson 118 days in 2021 to go through their inventory, or in other words, to turn over their inventory. And then, so that's the inventory turnover ratio. The asset turnover ratio is a little bit different in that it measures, how well the company is using its assets to generate sales or to make sales. And generally you want this to be higher rather than lower, because a higher number indicates that the company is using those assets to make sales, versus a lower number, which is less sales for the same amount of assets. So you ideally want this number to be higher. And so this would be your sales, with the way that you calculate this would be sales divided by average total assets. Again, you can use the average function there. And so you can see that for every dollar that the company has in assets, the company generates 52 cents in sales for 2021, or 53 cents. We can see that that's an increase from the previous year, which is a good sign. And so looking at those two numbers, we can tell that's in the right direction. And yeah, so that's a little bit easier of a ratio to calculate. And I forgot to mention that for these ratios, you typically want them to be higher rather than lower. So a higher accounts receivable turnover is telling us that we're collecting on the accounts receivables a lot sooner, which is good for the company because that means that they're getting the cash for the sales quicker, which then is better for cash flow purposes. And for inventory, you generally want that to be higher because that's saying that they're selling through their inventory faster, which is always a good sign for companies. Like, they don't want inventory sitting for too long. And yeah, so those are a few liquidity and activity ratios. Be sure to look out for next video on a few other, the profitability and solvency ratios. And feel free to leave any questions in the comments below. Thank you for your time.